Welcome to the Times of Industry show. I am very excited to have back on the line Mr. Rick Rule, and he's a phenomenal investor and a very well-known player in the resource sector for many decades. One of the most street smart individuals that we can have on the call from Sprott. And Rick, thank you for being on the call.
Pleasure. Thank you for having me on again. I appreciate it.
I want to ask you about the Federal Reserve, first of all. Listening to everything that Jerome Powell is saying, he's treating COVID-19 like a natural disaster, socially speaking. So he's saying, look, nobody's done anything particularly wrong. In other words, CEOs haven't mismanaged funds in a way that is, like in 2008, or investors weren't as giddy as in the dot-com bubble, or homeowners were not taking mortgages when they have no assets, no jobs, no income, like in 2008. So it came on the economy in sort of a way that is forced upon it. And he's saying, look, in terms of price versus reward, having high unemployment numbers for years and having people detached from the workforce, detached from their skills, etc., would cost this country more than to float these people along, etc., etc. And I want to ask you about that approach. First of all, do you agree with it or not, that this is good for the country or bad for the country? And then I want to ask you, when we create all that lending powers and all that spending power, who is paying for that at the other end? In other words, if this is just a good plan that we can just do every once in a while, then why isn't it being done? You know what I mean? Where's the price and who pays it ultimately?
That's a big topic, and I'll do my best to address it briefly and civilly with fewer four-letter words than it would likely deserve. I would prefer that Congress and the Fed read Nassim Taleb's book, Anti-Fragile, and think about the missteps that got us here to begin with. Societies in general and individuals in particular are supposed to save through the course of their lives so that when circumstances like the circumstance that we see ourselves involved in today hit, that they are anti-fragile rather than fragile. The fact that the Fed feels the necessity to do this speaks volumes to the way that individuals and the governments themselves have conducted themselves over the last 30 years, which are the most benign in economic terms 30 years in recorded history. The fact that after a boom that began in 1981, that we can't handle a setback in 2020 speaks volumes for the way that our society has decided to conduct itself. From their point of view, it may very well be necessary because they have allowed people to spend rather than save for a very long period of time. As to the technique, I think they're employing two techniques, both of which I think are wrong. It's worthy to note that a young black man was murdered a couple of weeks ago for attempting allegedly to pass a counterfeit $20 bill. The Federal Reserve is passing approximately $1.5 billion in counterfeit currency a day as we speak, because quantitative easing, if it was viewed objectively, would be called counterfeiting. It's issuing specious currency. If that were such a good idea, the Federal Reserve should allow me to pass rules and you to pass Gantzes. When they do it, it's policy. When you and I do it, it's a felony. Other than counterfeiting, of course, what they do is borrow. That which they spend that they don't counterfeit, they in fact borrow. And that is a different set of circumstances. The balance sheet of the US government, which is to say the balance sheet of the guarantor of US Treasury securities, has $24 trillion in recourse liabilities, maybe 18 trillion net of their own balance sheet, and $100 trillion in off balance sheet liabilities. And the ability to service that debt comes from the national income, which is to say taxes and fees minus expenses. The problem is that the national income is in deficit. It adds to the debt. So my suspicion is that their avenue of first recourse, which is borrowing, is bad, and their avenue of second recourse, which is counterfeiting, is bad too. As to who pays, Lior, you're a young man, and the answer to who pays would be best addressed by you by looking in the mirror. One of the things that we're seeing right now is an intergenerational transfer of benefit and wealth on a massive scale. My generation, the baby boomers, the people who have voted themselves all of these benefits, are happily collecting them and leaving the bill, both in terms of recourse liabilities and in terms of off-balance sheet liabilities, but also in terms of a debased currency to your generation. Sorry about that, but I think that's the easy reality.
It's very interesting because Ron Barron, who runs mutual funds, etc., as a billionaire, he was also commenting that, hey, basically, currency is just a means of exchanging, where there is zero reason to regard it as a store of value. There is nothing about any fiat currency that's a store of value. It's just talking about it wasn't talking about gold in particular, but just saying, look, when you have any currency, it means nothing but a way to transact. So apart from having savings in terms of what you need to live your life, have the rest in either ways to protect your wealth if you don't want to grow it, or in ways to grow your wealth. And I want to ask you about ways to protect your wealth, gold in particular. Gold silver ratio. I had Mr. Ross Beatty on the phone a couple of weeks ago, and he was saying, forget the gold silver ratio in terms of what it means. It means it doesn't mean much anymore. They're so different, gold and silver, that you have to look at it in a new paradigm, so to speak. Is there anything you want to comment on the gold silver ratio? Do you use it in anything, in any analytics, or in any way, shape, or form?
I agree with Ross completely. I don't understand why the gold silver ratio should be important. The relative abundance or scarcity of an element in the Earth's crust is only one factor in determining its price. Utility is a much more important factor relative to abundance and scarcity. With regards to silver, while it is a monetary metal, it's also an industrial material, which adds to utility. A more important thing is that in terms of the supply side of silver, most silver that's produced, most new supply, comes not from primary silver production, which is to say from silver mines, but rather from copper mines, gold mines, lead mines, and zinc mines. So although the silver-gold ratio is an easy thing to point at and an easy thing to quantify, and it plays on people's emotions, I'm not sure that it's a useful metric in terms of establishing either absolute or relative valuations between the two models. And I don't use it at all, except for as a tool to measure sentiment.
Would you say that basically, in order for silver to go back to some sort of a ratio that we know historically, governments or central banks will have to come back and say, "Hey, we feel that silver is monetary, same as we feel gold is monetary." In other words, because the monetary aspect of silver is only governed by retail investors who want to buy it, as compared to gold, which central banks and governments have in reserve. Is this the big benefit? Is this the main reason why the silver to gold ratio is so wide as compared to history? or as
I,
compared to 1971?
I think you said three things there. The first is, as I say, that I don't believe that the price of gold or silver is tied to a gold-silver ratio in any way, shape, or form. The second thing is that I believe that central banks are attracted to gold as a creature of last resort. A vote for gold is, in one sense, a vote against central bankers. And left to their own devices, my suspicion is that central bankers would all prefer to hold in reserves other fiat currencies and interest-bearing sovereign notes. That's difficult now because the sovereign notes don't seem to bear any interest, with the exception of negative interest. And the central bankers, I think, have no choice but to hold gold because they don't trust each other. In a different economic circumstance, I think that you would see central bank demand for gold, let alone silver, being very low. In this circumstance, they're drawn to it because they have to be drawn to it. The third thing that I would say is that given the market share of precious metals generally, gold and silver, worldwide, my suspicion is that it will not be central bank buying and selling that determine the price of gold and silver over the next 5 to 7 years. It will rather be private parties, private financial services institutions, private investors, corporations, who want to store a portion of their wealth in a medium of exchange, that is to say, a highly, highly liquid monetary instrument that's simultaneously a store of value. The reason that precious metals have been useful for millennia is that they are at once a store of value. They're not a promise to pay. They constitute payment in and of itself. But they are also uniform and highly liquid. And I don't think ultimately, given the market share of gold and silver as monetary instruments, which is very small, that their price will be determined primarily by central bank purchases or sales, but rather as an alternative to fiat money, sovereign instruments, and central banks. History has taught us, when I say history, I'm not going back millennia now, I'm really going back 40 or 50 years, that in precious metals bull markets or even precious metals recoveries from oversold bottoms, that gold moves first. It moves based on fear. When the market has been established in gold, when there is some momentum in gold, silver, which has traditionally been the poor man's gold, moves second. But when it moves much faster and much further. And my suspicion is in this circumstance that history will repeat. Silver will move after gold, but when gold establishes momentum, silver will move further.
Understood. I want to ask you about COVID-19 and what is the main takeaway, investing-wise, that you've taken from it?
Well, I would begin by saying I'm not an epidemiologist, so your listeners should take my remarks as being those of a credit analyst or a loan shark, depending on your point of view. I'm amazed at the recovery that we have seen, at least in North American equities markets after the COVID episode. I guess that speaks to the power of the Federal Reserve and the faith in its ability to continue to counterfeit. Because the economic impact of the COVID-19 virus on a global basis, but also in the United States, has been dramatic, and I don't think it's been measured. I'm delighted that people have such confidence, although I'm mystified by it. We have a circumstance, as an example, in the airline industry, where the recovery in airline stocks has been breathtaking, although occupancy, airline occupancy, has increased only from suicidal to non-viable. The recovery that we have seen in equity markets and debt markets from the devastation wrought by the virus has been, in my mind, absolutely mind-boggling. My suspicion is that the impact of the COVID-19 virus on the American economy, and in fact on the global economy, is not over. and that it has been more severe than one would believe if one got all of one's information from equity markets. I would hasten to add, however, that the COVID-19 virus was just the latest of a series of threats on the global economy. Things like protectionism, economic nationalism, deficit finance, artificially low interest rates, the discouragement of savings in favor of consumption. All of these circumstances challenge the economic ascent of mankind. And I'm afraid that the COVID-19 virus has only added to these circumstances. My concern is that many economic players, but particularly equity market players and debt market players, in the circumstance that we're in today, are confusing liquidity, which is to say cash in the system, for solvency. Solvency meaning our ability to service and retire the debt that we have acquired on a personal level, on a corporate level, and particularly on a community or government level worldwide. And I think that as the COVID-19 virus disrupts industries worldwide, particularly service industries, which are, among other things, starter level employers worldwide, that we haven't heard the last of the virus, nor have we heard the last of society's ability to cope with the economic dislocation caused by the virus, nor have we heard the last of the solvency issues as companies and individuals whose cash flows have been interrupted or perhaps halted as a consequence of the virus become unable to service their obligations or maintain their lifestyles. Questions in reverse order because you packed a lot of questions into one little time segment. I don't think we need to worry too much about attracting investors into the gold sector. I think that the gold price will do that for itself. I really believe that the wind is in gold sails. Declining confidence in central banks and negative interest rates in other savings products, be they demand deposits at banks or government securities, will have the effect, as they have in the last 6 months, in increasing investor acceptance and interest in gold. And the increasing gold price will continue to impact, in a positive sense, the operating results of gold companies, particularly gold companies who operate outside the United States. It's worth noting that despite the challenges that the US economy and the US dollar face, that the challenges that the US faces seem less daunting than the challenge other places face. The consequence of that is that currencies in some major gold producing locales, including first world locales like Australia and Canada, are declining. And in those places, the input costs are going down because they're denominated in depreciating currencies, the Canadian dollar and the Australian dollar, while their selling prices are in US dollars. Added to that, the incredible declines in energy prices works in effect, to lower these companies' costs. So what you're seeing is a very virtuous circle, increasing gold prices and decreasing costs. In the last 45 years, what you have seen is that gold has moved before the gold equities have moved, because they're perceived, rightly, I believe, as different asset classes. The increase in gold price has to reflect itself in increasing operating margins, which you're beginning to see. The income statements of the producers improve. And as the income statements of the producers improve, their balance sheets improve too. And the consequence of that is that the gold stocks begin to rise. Traditionally, the biggest, the finest, the most liquid gold companies move first. And that's certainly happened in this rally. As the big companies, the liquid companies, increase in price, they become expensive relative to mid-tier and single asset companies. And as the delta between the valuations of the two companies increases, the ability of the big companies to buy small companies and the likelihood that big companies do buy small companies increases. And you begin to get two things. Money shifts from some of the big producers to some of the smaller producers in a valuation quest, at the same time that the mergers and acquisitions market heats up. And I think that this cycle will follow the last cycle. My hope, I must add editorially, is that the mistakes that the mining industry made in the decade 2000 to 2010, which is to say growth at any price, I hope is fresh enough on investors' minds and managers' minds that the acquisitions that the industry undertakes are strategic acquisitions and well-priced acquisitions. The acquisitions, the merger and acquisition activity that we've seen in the last 18 months has been very rational and very healthy. The merger and acquisitions market that we saw in the middle part of the 2000 to 2010 market was a bit crazier, and I think really doomed that market. I think we're in a very, very virtuous circumstance at present.
Okay, so let's talk about one of these ways to maybe anticipate which sort of a company is a great buyout, the optionality angle. Companies that are buying proven resources in the ground, maybe in the measured and indicated, maybe the inferred, maybe both. They have large resources. They appeal to these majors. You've talked about in the past companies that are favorite of yours, and I want to ask you: do you see the optionality plays, and if you want to mention anyone in particular doing well as these majors look to replace their depleting assets?
Well, optionality, your listeners should understand what optionality is. Optionality refers to a class of companies that have fairly large gold resources and reserves that are either marginally economic or uneconomic at current prices. The consequence of that is that relative to the in situ value of the gold that they have in the ground, they offer great leverage to higher gold prices. Not much net present value, but very, very, very large values if, as we suspect will happen, the gold price increases. And there is enough investor interest and enough investor belief in higher gold prices that the optionality companies are beginning to participate in this bull market. They are usually late cycle participants, which is to say that the highest quality companies with the best balance sheets and the income statements move first. Then the companies that are perceived as being targets, single asset producers, move second. And then the tertiary companies, the marginal producers and the optionality companies move later. This market, the market that we're in, has been dramatic enough that really all classes of stock, all classes of viable companies seem to have moved. And some of the larger optionality plays, I'm thinking NovaGold, Seabridge, as an example, have been very strong participants in this rally. I would look, admittedly, as a speculative strategy to the smaller and unloved optionality plays. I believe you know a young Vancouver-based entrepreneur, Amir Adnani, as an example, with Gold Mining Inc. So that would be an example of a company that acquired reserves and resources that I would suggest have very little net present value at $1,700 gold, but would be probably extraordinarily valuable at $2,000 gold. The market capitalization of the company relative to the indicated and inferred resources that they have is quite low. Now, your listeners and speculators need to know that speculating in optionality is not the same as investing in Franco-Nevada or Wheaton Precious. But for that portion of one's portfolio that one can allocate in search of much, much, much greater returns in exchange for much greater risk, the optionality play is very, very attractive. I myself was very active in optionality plays in the decade of the 1990s when companies like Silver Standard and Pan American Silver went from 70 cents and 50 cents respectively to over $40. So the optionality plays have a special place in my heart, given how generously they rewarded me in the 1990s. The difficulty is that your listeners need to understand that it's a speculative strategy, and they need to confine that strategy to that part of their portfolio where they can afford the risk of being wrong with regards to their expectation of a gold price increase. Make no mistake, I expect the gold price to increase, but the fact that I expect it doesn't make it necessarily bound to occur. If you believe, like I believe, that the wind is in gold sails and the gold price is going higher, and the consequence of that is a very handsome precious metals equities bull market, all of which I believe, there is a place in speculative portfolios, certainly for the optionality plays, and in particular for the smaller, unloved, unknown optionality plays. You know, Lior, it's important in this discussion of optionality to take a look historically at precious metals equities bull markets in the last sort of 45 years. There have been 8, and I believe we're embarked on the 9th. Recovery from oversold bottoms. And what you see is that these are one of the most volatile asset classes on the planet. The most tepid response, which is to say the least amount of upside that I have seen in the last 8 recoveries from oversold bottoms, has been an index recovery, not the best stock, but rather the market index recovery of 180%, and the best was 1,200%. So the idea that within a small portion of somebody's portfolio, that part of the portfolio where they could afford substantial risk, that you try to substantially outperform what is already a very handsome return is a very attractive, sort of promise if you can afford the risk.
I understand exactly what you're saying. If you are in a situation where you take a nice position size, not overwhelm yourself and not risk yourself, your family, etc., you take a very sizable and strategic position, and you look for huge returns, then why not go for something that's high risk, high reward instead of just high risk and mediocre reward?
Right.
I want to ask you about if you look at the entire commodities universe, is there any particular commodity just in general just seems to be much better than the other ones right now, much cheaper, much more hated, etc.?
The entire commodity complex, from a historical point of view, is cheap. But if, like me, you expect that we're going to have a bit of an economic reckoning as a consequence of too many years of artificial economic growth, unfortunately, some of the recovery in commodities prices that will necessarily occur won't occur quickly. My belief is that the best immediate recovery that we're going to see in commodity prices will continue to occur in precious metals, which is to say gold or silver. Having said that, oil was substantially oversold, and Greta notwithstanding, the world will run on oil, certainly for my lifetime. I suspect peak oil demand will happen about 2035. So any price in oil less than 55 or 60 US dollars a barrel in the 3 to 4 year time frame becomes cheap. Uranium is cheap. Many things are cheap. Most speculators don't seem to have the patience to look for a 2 or 3 year recovery, which might be required in the industrial commodities. And although I suspect that there will be substantial payoffs investing in companies in those commodities, which I myself am doing personally, the remarks that I make that will be acted upon by your listenership are probably mostly confined to precious metals. And I think that this in the next 12 to 18 months will probably be rewarded.
Rick, what are the trusts and ETFs that Sprott provides, or in general, you guys at Sprott, what is the best way to learn everything that you can do for investors?
Well, I'll tell you, I'm going to give your listeners an incentive to get to know us, if I might. If your listeners go to Sprott USA, that's SPROTT USA, all one word, .com, /rankings, you will find a web form there. And if you enter the precious metal stocks that you have in your portfolio, I will rank those stocks 1 through 10, 1 being best, 10 being worst, and I will comment personally on them where I feel that my comments have value. In addition, I will email back a Barron's Gold Mining Index chart, which has the longest running and the broadest gold mining equities index available, a 50-year index, which talks eloquently about the 8 prior recoveries from oversold bottoms that I related to you. And I'll also send a 100-year commodity chart, which will show the relative valuations of commodities to other sectors of the economy going back 100 years. I would say that the best way to get to know us is to have us evaluate on a no obligation basis one's existing portfolio. If as a consequence of that you want to get to know us better, absolutely go to the Sprott USA website and the Sprott.com website. We manage or administer about $13 billion in natural resource investments, mostly in precious metals. We have a wide range of investment products, including the Sprott Physical Trusts, physical gold, physical silver, physical platinum and palladium. And of course, the parent company stock, Sprott Inc., is listed on both the Toronto and the New York Stock Exchanges under the symbol SII. I should correct myself. Will very shortly be listed on the New York Stock Exchange under the symbol SII. So probably the easiest way that one could avail oneself to all the services of Sprott and all the products of Sprott would simply be to own the parent company and benefit from every product and service that we offered.
Yeah, Rick, thank you very much. That is an incredible way to just start and kick off the relationship. You can go to sproutusa.com/rankings. You put in every ticker that you own in the natural resource sector, and you personally will come back with a rankings and commentary. And I should say, I am a client of Sprott USA. I have my brokerage account with you guys. And congratulations on the upcoming uplisting to the New York Stock Exchange. We saw the consolidation of shares, and that is very, very exciting. And we will definitely have the link to sproutusa.com/rankings in the description box below this video. Rick, thank you very much for making yourself available today.
Thank you so much for the opportunity. I always enjoy these.